Hello, and thank you for checking out another video on long-term care and nursing home coverage or care planning. We view those terms not interchangeably at our firm. We think that planning for long-term care is one issue and nursing home coverage is a completely separate and unique issue. And we can start by addressing that as we get into this topic. There are really multiple ways of receiving care. And the first and most desirable method is what's called in home care. That is where a person is able to stay in their current residence and have either a family member or an individual, a care provider, come in and give them care at their own personal home. Coverages that you might insure for this might cover the widening of hallways or doorways. It might cover bathroom changes, something like that that might be necessary. Bottom line, this is very, well, I shouldn't say very, this is the least disruptive to the individual who is receiving the care and the most desirable choice, and probably the last thing that people think of when they're assessing long-term care. It is covered by many long-term care policies that can be acquired in the marketplace today, and we will get into more about that. The second sort of care that is an option to consumers today is going to be a assisted living facility. So that is outside of your primary residence. It is traditionally in a villa or an apartment type of a facility. It can be at the same nursing home facility that someone might move into as well, just maybe a different wing or different area. It's very common in our area. And this is the second choice that people would typically want. This includes a facility, an offsite facility. This typically does not have 24-hour nursing coverage. In other words, there is not a nurse on call typically at this sort of a facility. The last and least desirable choice for most families and most people who would be receiving the care would be nursing home coverage, and this is actually 24-hour or most of the time different degrees of 24-hour care in a facility. Probably the least or last choice that an individual would prefer when they're thinking about this as an option. There are really 3 or 4 major ways that people can cover this expense in today's marketplace. The first is doing nothing. It's obviously very cheap to do nothing because really you're just relying on your current assets to be spent down or utilized to pay for your coverage. Coverage is very expensive. Usually it does someone's assets in a rather quickly time frame unless they have a huge nest egg amassed to cover the expense or a sinking fund. The most expensive or highest premium coverage that you can purchase is what's called a standalone long-term care insurance contract. This is a separate policy from any other policy. This policy would only cover, well, it would cover all 3 sorts of care. It would only cover you in the event that you could not perform all your activities of daily living. It would cover, like I said, all 3 parts of care, usually, not always, and it would have the highest premium. It would be your best coverage, and it is almost always use it or lose it. Very similar to how we function with our homeowners insurance or our car insurance. If you don't use those insurance coverages every year, you lose the money. You're still covered the next year if you make the premium. The second option that is becoming more and more popular over the last few years is a rider on a life insurance contract. This is a very different way of covering the expense or the potential expense and need because it is not a use it or lose it type of a coverage typically. This is going to be typically a rider or an addendum to a life insurance policy that could be added on for an additional cost, of course, and it would allow you to utilize your death benefit, typically, for a portion of your care. Typically, the death benefit is tied to a percentage. That percentage then is an amount that you would receive if you, again, would qualify for care. The nice thing about this is if you don't need the care or you don't use the care, then your death benefit still gets paid out to your beneficiaries, assuming the premiums are made and the contract is still in force. So that's a good thing. The last type of coverage is going to be some sort of asset-based coverage. So long-term care, again, riders or addendums or contract features can either be built into certain insurance companies' products or financial firms, and that rider or addendum can pay out a claim, again, if you qualify and you would choose to go that route, that can function very similar to how a life insurance contract would function. The difference being you would not get the amount based upon the death benefit. You would get your amount based upon the assets that you have in whatever contract you would be referencing. So it would typically be a much, reduced benefit amount, but again, you're going to have a much reduced cost to acquire that sort of coverage because you're putting your own money into the contract. There are many variations of these three types of coverages, which we can get into if you have interest. There are also many firms that offer these types of coverage that we can get into if you have interest. Just reach out to us. We might do some more specific videos on individual types of riders and what those look like. Those have changed quite a bit over the last, I'd say 5 years. But for now, we'll leave it here. If you have questions, reach out to us. If not, thanks for checking out this video, and we will look forward to the next one.